Buyers are having a little bit harder time getting into properties. So how could this 3-2-1 buy down help them out?
Well, from the buyer's perspective, if they're scared of the interest rates right now, the program really helps them to ease into the mortgage, the higher rates, because there's a 1-year buy down, a 2-year buy down, a 3-year buy down.
So you can mix and match this. So you can get a seller credit and you can apply that towards your closing costs. You can use it to pay upfront mortgage insurance. And then you can also, let's say, buy your loan down a point. So you can get in with very little cost right now and have a mortgage payment based on like a 3.5 or 4.5% interest rate based on what you qualify for with the buy down. Yeah, so you can get in a lot cheaper with the monthly payment. You're not going to have mortgage insurance for the first, 6 months or a year or something like that. And then also pay down your closing costs. So hey everybody, thanks for joining us. Today I have Kathy Gray here. Kathy Gray has been a friend of mine for a long time. She's with Guild Mortgage. She's been doing loans for I don't know how long, we'll let her tell you. And today we're going to talk about a special loan program called the 3-2-1 buy down. Kathy, take it away and tell us a little bit about yourself and what you do.
Well, that is correct, Jason. I've had the pleasure of working with you in the past years and meeting you a long time ago. And we have a lot of happy clients between us. I have been with my company now for almost 14 years, but I've been in the industry for longer than that. Started out as a loan processor, moved my way up to underwriting, and I thought sales was the next step for me to do. And been doing that for years. And I really enjoy working with the clients that I am blessed to work with.
And you're very good at it, Kathy. Nothing but raving fans. Everyone's happy when you successfully get them into the property. Do a great job.
Thank you.
All right, Kathy. So today we're going to be talking about the 3-2-1 buy down. I know it's a program that you wanted to discuss today that you are very adamant about.
Yes. Well, it's the new thing right now.
Yeah. So I'm very curious about the 3-2-1 buy down. So right now with the market, the interest rates are really high. And so, buyers are having a little bit harder time getting into properties. So how could this 3-2-1 buy down help them out?
Okay. Well, from the buyer's perspective, if they're scared of the interest rates right now, the program really helps them to ease into the mortgage, the higher rates, because there's a 1-year buy down, a 2-year buy down, a 3-year buy down. So whatever program they qualify for, or they choose to use, or the money is available to apply, they could, like, for example, let's say the current rate is 6%. On a 3-2-1 buy down, the first year would be 3%, and then 4%, and then 5%, and then on the fourth year they ease into the 6%. Now, if in the case that they refinance, they don't lose that money, so it gets applied to the payoff. So it's a win-win. It's a way for the buyers to, again, ease into the payment. It's predictable. They know how much their payment is going to be the following year. And, there's no guessing game to it. The buy down funds are currently provided by the sellers. We call it seller credit. So we apply the seller credit to the buy down, and it sits in like a little escrow account. And every year or every month, you pull out what you need to make up the difference to the actual initial interest rate of 6%. So it's a great program for those buyers that are lucky enough to have the seller credit to help them ease into the payment. And that way they don't have to worry about, how am I going to make the interest rate at 6%? You ease your way into it. Now,
does it have to be a seller credit, or can they come in with the cash?
No, the buyer cannot pay for it at this current time with the programs that we have now. The lender also can apply a lender credit, but the market doesn't justify that right now. So the only way we could do it is with seller credit.
So instead of making like a full price offer, what you could do, well, I guess the best way that this could help out my clients is, so like, let's say we have a seller that instead of lowering their price, maybe they can offer the buyer a buy down program instead of doing the reduction.
Correct. And that would be a win-win for both, because you have a seller that doesn't necessarily need to reduce the price. As long as the comps are there and the value is there, instead of reducing the price, or maybe a house that's been sitting in the market, that would be a great incentive for the seller to say, hey, I will provide the funds available for a buy down program.
So when I have a buyer that's interested in a property, maybe it's been on the market a little bit longer, and maybe we think it's overpriced, rather than offering like a lowball offer, what we could do is maybe give them a full price offer and request, like a 3 to 6% credit for this buy down, right?
Correct. Yes. As long as we don't get in trouble with the appraisal. So if you're not asking for way too much money, and it's going to come out or appraise. So
right,
yes,
right.
That would be. Now, for a year, you may not need as much credit, but for the 2 or 3, you may need a lot of credit to make up that money. And it depends on the purchase of the house and the loan amount. So getting into the types of loans, well, if your down payment for your loan is only 3%, the max seller contribution on a conventional loan is also 3%. So that 3% may not be enough for the 3-year buy down. So we would look at the 2, the 1, or maybe what I like to call a permanent buy down, which means just buy down a point or half a point, or apply to your closing costs, or pay the mortgage insurance. All these ways that we can use seller credit to help the buyer.
Okay, so you mentioned a permanent buy down. So what's the difference between a permanent buy down and a temporary buy down?
Okay, the temporary buy down program, they've been around forever, but because the interest rates were so low, it really didn't make a lot of sense. But now as the interest rates start increasing, all of a sudden this popularity of this program is coming into play again to help the buyers ease into their real mortgage payment. Or interest rate. Now the buyers still have to qualify at that higher interest rate. They just have the benefit of starting off, 1, 2, or 3 years at the lower rates. The difference is what I call the permanent buy down is because it's basically, we just use the seller credit to apply it one time and one time only to either buying points, paying the mortgage insurance, or paying the closing cost. And then that's it. Their payment is that interest rate will not move. Unlike the temporary buy downs, that's when the interest rate will be escalated by those number of years that it'll apply.
Okay, so the buyer can have the choice between having a lower payment for the first couple of years, and then they ease into their regular payment, or they could do a permanent buy down and they could have a lower payment for the entire 30 years. Is that correct?
Correct. The life of the loan. Yeah. They
nice.
pay it off. I mean, it helps the buyers, and the sellers really don't have to do much. I mean, you don't have to do anything other than agree to provide the buyers with the seller credit. And let's say it could be $3,000, it could be $5,000, it could be $10,000, whatever is justifiable for the property. And then it'll be us as a loan officer to determine and do the worksheet that we do have to calculate which way is going to benefit the buyer the best way.
So on this one of these handouts that you sent me, for an example, so for the first year they could, let's say, qualify. Let's say their payment, the full rate is 6.5. So like for the example you sent me, year 1 payments only based on a 3.5% interest rate. So that's
that
like
would be the
half.
3 years. The buyer will still have to qualify at the higher rate or the initial rate. The 6.5. Yes.
So is there anything else that they need to do special to qualify for this program?
Not really. Just qualify again. Go qualify at market rates, and the program is like anything. Conventional. The buy down is for owner occupied and primary residence only. It's for single family residence, condos, PUDs, or planning and development, or townhomes, whatever you may want to call them. And FHA and VA are the only ones that will do manufactured for the buy downs. So
Okay.
again, every program has its own requirements, and the loan officer is the best person to guide you along with it and prepare those calculations so we can figure out which way is a better way for the buyer or a better benefit.
Okay, nice. I love it. I love it. Mm-hmm. So, let me ask you this. What happens if, we put a buyer in a 3-year buy down, and so for the first 3 years they have a super low interest rate. What happens if they want to sell, within the first 2-3 years or something like that?
They don't lose it. We can't give it. It is money basically that was given to them from the seller as seller credit. So it's their money. So it gets applied to the principal payoff or balance. So it can't be given to the client or the buyer, but as in cash. They're not going to get a check, but it'll reduce their balance or payoff.
And this is going to be a much more significant savings over the long term than if they just offered a lower price.
Well, that's a decision they have to make. If the buyer is comfortable paying market rates and they're not asking, they want to make a clean offer, they don't want to ask for any seller credit, that's their option. So a 30-year loan is a 30-year loan, right? So if these are mainly for the buyers that they're saying they're not going to buy until the interest rates are low. So here's an option. Okay, the interest rates are 6%. Let's say, for example, you have the benefit with this program to start the first year at 3%, 4%, 5%, and so on until you get to the 6%. So, now what's the reason why you're still on the fence?
Right. I'd be interested to see like a long-term chart on like what the savings would be versus like if you just offered lower on the property versus if you did the 3-2-1 buy down, like which one would save you the most money over the long run. That would be an interesting graph to check out.
That's a good point. I don't have one because I don't believe that we have had that many. The program just became popular this year again, now with the interest rates going up. So I don't know that there is such a chart, but I'd be interested too.
Yeah, I would love to see that. So it's just a normal loan process. Should
Yes.
take the standard like 30 days?
Yes. Yeah, because when a loan officer does the pre-approval, we'll go over the interest rates, that we currently have. And interest rates change daily. They're depending on buyer's FICO score, buyer's down payment, et cetera, right? So we will discuss it. Now, once the contract comes in and we see that there is seller credit available, that kind of like the light bulb goes on. Hey, let's use that seller credit to the best advantage for you. And that's when we really can calculate an amount because we know what the purchase price is. We know what the loan amount will be. We know what their down payment will be. We know what their closing costs will be approximately. And we will do our calculation to see which way benefits the buyer. Is it better to apply to $10,000 to just the closing cost and that's it? Or is it better to buy points to lower the rate and then we're done with? Or is it better to apply it as a buy down?
Yeah, no, I like that. It gives you options. And I can see where a buyer's gonna have a hard time with that initial payment shock, especially if their rents, if their mortgage is going to be a lot more than their rent. And so they could use this 3-2-1 buy down so that they could kind of ease into their full payment
Exactly.
rather than just being hit with it right off the bat and having that payment
Exactly.
shock. So you mentioned that, for conventional financing, there's a 3% max. But also here, I'm looking at another
Yeah,
handout you sent me. So if someone's going FHA, they can get all the way up to a 6% seller credit. Is that correct?
that is correct. Now, 6% right now, that would be a lot of money. And, there's another discussion on that. But if the buyer is only, let's talk about conventional first. So if a conventional buyer is only able to put 3% down, then 3% seller contribution, that is the max. Okay. On a conventional loan, however, if you can do 10% or more, then it's 6%. And at 25%, the seller could actually apply 9%. But, that's a lot of money. What seller is going to give you 9%?
Right.
But for VA is 4% and FHA is 6%. Now we typically don't see that much money because, also too, our purchase prices are so high. That amount would be astronomical, right? So however, you cannot pay more than what the actual closing costs are, or you're going to leave money on the table.
Right,
So
right.
that's why before a loan officer locks a loan, we have to know these guidelines and we have to know what type of loan we're dealing with and how much down payment they're providing so that we don't leave money on the table.
Well, that's where you come in, Kathy.
Yes.
That's where your expertise comes in.
Before we lock a loan, we have to pay attention to these things on the buyer's behalf.
No, that makes a lot of sense.
Mm-hmm.
Let's just, I'm not sure if you could do this off the top of your head, but let's just say it's like a $500,000 house. Like, how much credit do we really need in order to have like a significant buy down? Like, could we get away with, like 1% or 2%, or do we have to, ask for 3%?
No, and that's the option that I was talking about. So with the 3-2-1 buy down, for example, I do have an example here with I have a $500,000 loan amount that I'm going to talk about. So with the 1 year buy down, you would need roughly about let's round it up, about $3,800. With a 2 year buy down, you're going to need about 11 grand. And in a 3 year buy down or a 3 year, that's $21,000. Well, that doesn't seem realistic, right? But so let's say the seller is just giving you a flat 10,000. Well, that's when we can apply it to the other options. Maybe just buy a point, maybe buy 2 points, maybe pay for the mortgage insurance, because on a conventional loan, you can pay your upfront mortgage insurance at the beginning and not have a monthly mortgage insurance payment. So there's other options. If we don't have enough money that was realistically given to support value, because that's where you guys come in. How far out can we ask? And you guys would also need to know as real estate agents, how much down payment is the buyer giving? If they're only doing 3%, you're obviously not going to ask for more than 3% because, again, you don't want to leave that money on the table. We can't use it.
Right.
So
you can mix and match this. So you can get a seller credit, and you can apply that towards your closing costs. You can use it to pay upfront mortgage insurance, and then you can also, let's say, buy your loan down a point. So you can get in with very little cost right now and have a mortgage payment based on like a 3.5 or 4.5% interest rate based on what you qualify for.
With the buy down. With the buy down.
Yeah. So you can get in a lot cheaper with the monthly payment. You're not going to have, you could maybe not have mortgage insurance for the first, 6 months or a year or something like that. And then also pay down your closing costs.
What was that about not having any payments?
So basically you could get into a house with, a lower monthly payment to start out.
Right.
You can maybe use some of the money to pay off your closing costs. and also pay some upfront mortgage insurance. So you don't have to worry about that for the first few months or 6 months to a year or however much money you get, correct?
Yes, it depends on how much money we're able to, have from the seller credit, and how much the program will allow, because again, 3% may not be a lot of money on the lower priced homes compared to
Right.
a higher priced home.
So it's definitely something to consider rather than just writing a low offer, is to try to get as much as a seller credit as you can. And then you can apply that to one of these buy downs, your closing costs, or your mortgage insurance.
Right. And then just
I
to
love it.
clarify, like 1 point is 1% of your loan amount. So if you're paying
Okay.
half a point, that's 0.5% of your loan amount. Also, because the rates and the prices or the points change daily, let's say today 5% was at 1 point. Tomorrow it could be 4.5 at 1 point if the rates came down. But also tomorrow could be 4.5 at 0 points. So it's unpredictable. We don't know what interest rates are going to do tomorrow. So we have to go by how many points for the day that you're going to lock a loan. Could be a quarter, could be half, it could be 3/4, it could be a point, could be 2 points. So that's also another part of my job that I have to stay on top of.
And interest rates just went up again, right?
Today they did, in anticipation of what's going to happen this week. So we'll see.
So if you're getting priced out of the market right now, the interest rates are too high, definitely consider getting a seller credit and getting one of these 3-2-1 buy downs. You can reach out to Kathy Gray. She'd be more than willing to help you, happy to help you. Kathy, so if people want to reach out to you and have more information about the 3-2-1 buy down, what is the best way to get a hold of you?
I can be reached by my cell phone at 805-701-7467. My email is kgray@guildmortgage.net. My office is in Oxnard. But I think the best way to reach me is my cell phone. Call me, email me, or text me.
Okay, awesome. All right, everybody, what do you think? Do you think the 3-2-1 buy down is the way to go, or do you think writing a lower offer and just lowballing the seller would be the best choice? Let us know what you think in the comments. If you found value from this video, please make sure to like. It really helps us out with the channel. Please subscribe so that you can watch future videos. We're going to be doing these every other week. And stay tuned. Hope you join us again in the future. Thank you, Kathy, again, and we look forward to talking to you soon.
Bye.
Bye.
Have a great day.